imagine this. 2 decades ago, you had just $1,000 or rupees 50,000. Maybe it was your bonus check. Or your savings from skipping nights out, you could have just bought a shiny new phone or invested it. Most people chased Apple, Amazon, Facebook, the usual suspects. But what if instead you picked a random trucking company or a boot brand from Colorado or some no-name builder that doesn't even own land? You would be sitting on $100,000 plus today. No hype, no viral headlines, just quiet domination. These are some of the real monsters of the stock market, the ones that silently outperformed FAANG by a mile. In this video, we'll uncover 6 of these mind-blowing stocks, the companies that went from overlooked to being unstoppable, and we'll break down how they did it and what you can learn from them. Number 1, the boring trucking stock that quietly crushed Google. Imagine a dusty highway in 2003, trucks rolling across states, hauling office supplies, tires, crates of who knows what. Nothing glamorous, no software, no cloud, no AI. Just a normal trucking company doing what trucking companies do. A trucking company so efficient, it doesn't just deliver packages, it delivers 42,000% returns. Back in 2000, Old Dominion's stock traded at just 40 cents, split adjusted, and today it hovers around $169 after the recent dip. But how? ODFL did the impossible. It built a premium brand in a commodity business. It's a less than truckload freight company, meaning it ships smaller loads for more customers. While competitors chased volume, ODFL chased precision. It refused to grow fast at the cost of service. They built a hub and spoke network of 250 plus service centers, owned nearly everything, trucks, real estate, terminals, and optimized delivery routes like a software company. And then came the metrics. Operating ratio under 80%, lower is better, ODFL leads the industry. ROIC consistently over 30%, EBITDA margins around 30%, free cash flow positive for over a decade. Now, this wasn't just trucking, it was capital efficient compounding. While FedEx struggled with margins, ODFL quietly compounded at a 28% plus CAGR, a return profile comparable to Monster or Apple. This is what stock market legends are made of. Boring businesses executed with unbelievable precision. Now coming to stock number 2, Transdim, the money machine hidden in your plane seat. Every time you buckle your seatbelt on a plane, every time your tray table locks, or when the overhead bin snaps shut, there is a good chance that you're using a Transdim product. But here's the twist. You won't see their name anywhere. That's exactly the point. Transdim Group makes aerospace parts so small, so boring that they don't even bother to do branding on them. Back in 2006, Transdim debuted at around $20 per share. Fast forward to mid-2025 and it now trades at a near $1,500 post-split, an astonishing 75x return over 19 years. It has turned $10,000 into $750,000 plus. So how does an aerospace parts maker grow like Intel in the 90s? Well, they were building a fortress of proprietary products. Think aircraft parts, cockpit components, walls, landing gear parts, all critical FFA certified and often single source. Airlines have no choice but to buy from TDG year after year. This monopoly engine runs on gross margins that are around 55% plus, EBITDA margins in the range of 45 to 50%, plus they have a masterclass in acquisitions, 80 plus brands each delivering earnings. Post-merger, they cut costs, tightened pricing and instantly boosted their profitability. But there is leverage in this play. TDG carries debt, still debt to EBITDA hovers around 6x, manageable given their fortress margins and free cash flow. That means once they win the airline trust, replacements keep on coming and they come with hefty price tags. And here's the punchline. This company is the definition of a cash printing monopoly, but from $20 to $1,500 tells a story of a silent monopoly, relentless compounding and real world wealth creation. Now coming to stock number 3, the $15 UGG boot that built a $1 billion fashion empire. There was a time when UGG boots were everywhere, from high school hallways to Hollywood sidewalks. Everyone from teenagers to celebrities wore them. They were big, fluffy, kind of weird looking, but insanely comfortable. What most people didn't realize, they were a rocket fuel for a stock few had ever heard of, Deckers Outdoor Corporation. Think UGGs are just fuzzy boots? Think again. Back in 2005, Deckers Outdoor was trading at around $1 a share. Fast forward to July 2025, it is sitting at $105 to $106. The X factor, from sheep to road running culture. UGG started its all comfortable boots that became a global fashion hit. But Deckers didn't just ride a craze they reinvented. In 2013, they acquired Hoka 11, an ultra-comfort running brand. What began as a niche purchase exploded into a $2 billion plus global mega brand. It was added to the S&P 500 in 2023. It has outperformed Lululemon, Nike, and even many tech names in the last 5 years. And the kicker, Deckers has no debt. They are sitting on over $1.2 billion in cash, which gives them the freedom to invest, acquire, or simply just keep on compounding. What does it offer to their investors? Revenue of over $5 billion, net margin of 18.7%, free cash flow $1 billion, enabling $1.2 billion in buybacks and virtually zero debt. Two powerhouse brands, UGG and Hoka, that dominate distinct lifestyle niches. Margin resilience was mid 50% gross margin, operating margin stood at 20%, and despite fashion cycles. Capital choice was no debt and strong buybacks. Valuation edge was multiply compressed, offering entry during dips. Dex teaches a powerful lesson. Don't dismiss fashion fluff. A company that executes brand strategy, expands globally, and reinvests smartly can outperform tech even after major pullbacks. Now coming to stock number 4, NVR Inc., the home builder that never crashed. When the US housing market crashed in 2008, home builders collapsed like dominoes. Lehman Brothers vanished, real estate giants filed for bankruptcy, stocks like Toll Brothers and Lenner plunged nearly 70 to 90%. But amidst the rubble, one company fell, but not nearly as hard. And more importantly, it bounced back like a slingshot. That company was NVR Inc., a low-profile home builder you've probably never heard of, and that doesn't even own land. While others drowned in debt and unsold inventory over their head, NVR's land-light, asset-lean model helped it survive, adapt, and eventually deliver a mind-bending return. Sounds counterintuitive, right? But that's exactly their secret. Most home builders are landholders. They buy big tracts, sit on them, and develop over time, which is risky and very expensive. But NVR said, no thanks. Instead, they pioneered a model called land-light construction. They option land instead of owning it. In other words, they pay for the right to buy land only when they are ready to build. This means less capital tied up, faster return on investment, massive resilience during downturns. Imagine buying it for just $12 in 1990, and today it's trading at approximately over $7,385. That's over a 600x return in 35 years. Every $10,000 would be roughly $6.1 million today. Yep, that's the real home builder outsprinting tech. During the 2008-2009 crash, while others failed, NVR stayed profitable. Key metrics as of July 2025 were: the market cap stood at $23 billion, TTM revenue stands at $10.8 billion, and net income TTM is also expected at $1.59 billion. Net profit margin stands at 14.7% versus the industry average of 5%. Free cash flow yield is roughly about 6.4%, which is top tier for home builders. Return on equity stands at 27%, incredible efficiency for a capital-heavy business. Return on invested capital was at 25%, signaling smart reinvestments from the company. Those margins are unheard of in home building. Most peers struggle to break even 5 to 10%. NVR runs at nearly 16%, thanks to cost discipline and pricing power. It has also been very shareholder-friendly. It has repurchased $750 million in Q1 2025, totaling $2+ billion in 2024. Cash flow is steady, risk is low, and the capital is used to compound value. While companies like Apple and Nvidia split shares to attract retail investors, NVR has kept its float tight and share count low. And the result of this is that it is almost impossible retail traders to trade it speculatively. So it gives you less volatility. Long-term institutional holders who aren't chasing headlines, NVR's story teaches that a boring model can actually outperform hype if it is steady, disciplined, and capital efficient. This isn't a temporary stock market euphoria. It is decades of consistency, unflashy excellence. Now coming to stock number 5. The hottest can on the Wall Street, Celsius. For years, energy drinks were dominated by two players, Red Bull and Monster. Then came a sleek, brightly colored can that looked more like it belonged to a fitness influencer's gym than in a gas station fridge. Celsius. No sugar, no artificial preservatives, packed with green tea, ginger, and caffeine. Marketed not as an energy drink, but as a fitness lifestyle in a can. And that branding twist, it basically changed everything for them. From obscurity to outperformance. Back in 2014, Celsius was barely known. Annual revenue just stood at $14 million. The stock traded under $1. Fast forward to 2025 and Celsius is now a $11.96 billion company. It started in 2015 as a low-profile wellness drink trading under dollars a share. By July 2025, Celsius sits at $46 a share, a blistering 3,000% plus gain in just a decade. A $10,000 stake back then is now worth over $300,000. The awakening from juice to lifestyle brand. Celsius didn't ride the traditional energy drink wave. Instead, it carved out a niche of clean energy for fitness-minded consumers. Think green tea with vitamins, zero sugar. It blew up first on Amazon and in boutique retail spaces. And the retail rocket fuel now came from a strategic partnership with PepsiCo in August 2022, making Pepsi an 8.5% stakeholder and securing Celsius shelf space in over 200,000 plus US stores overnight, including 7-Eleven, Walmart, CVS, and the list goes on. Even in college campuses, they were present. Within a year, Celsius sales doubled. And numbers have been actually shocking. TTM revenue now looks at $1.3 billion. Net profit margin stood at 11%, gross margin at 50%, and the price to free cash flow, which has been 39x, still high but justified by growth. Total return in 10 years have been above 5,000%. And all of this is with zero debt, $500 million plus cash, and free cash flow of over $200 million, a rarity in fast-growing beverage startups. So it has basically been a compounder in motion. Celsius, once under the radar, transformed into a fitness lifestyle phenomenon, sponsoring fitness influencers, gym classes, Spartan axes, leveraging a viral community on TikTok and Instagram, and using data-savvy ads to target health-conscious consumers. And the Pepsi deal didn't just push distribution, but it signaled validation. Wall Street responded with that thing. Key matrix is that the revenue growth has now been 50% year on year. Profit margin stands at 11%, which is rare for a still growing CPG. Zero debt cash balance has been $500 million plus, and Celsius taught the market you don't need fleshy tech to compound. Niche plus community plus clean growth is equal to explosive returns. Even in competitive categories like health, fitness, lifestyle, a brand can rise like a rocket. So in the end, guys, these were the top 5 picks that we wanted to discuss with you today, where you got to see a picture that beyond the FAANG, there are real compounders that often go underlooked. Now, if you want to invest in such global stock and have such global exposure, try Appreciate, because we help you invest hassle-free in global stocks around the world. Thank you so much for watching this video and subscribe to the channel for more such content.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.